Hello everyone, and welcome to the first episode of Simply Wall Street's Market Insights for 2025. First off, let us say Happy New Year. We hope you had a great break because we sure did. 2024 was a jam-packed year, which no doubt kept a lot of us on our toes. So, what does 2025 have in store for us? We've taken a look at a bunch of market outlooks from research teams around the world and selected some of the insights we think you'll find useful or interesting. This is the first part of our coverage on the outlook for 2025 and looks at the themes and catalysts most commonly mentioned. We're also highlighting a few insights relevant to specific countries and regions. Next week, in part 2, we'll share the best insights about sectors and key industries in 2025. Now, before we dive into what happened in markets this past week, here's our quote of the week from Rainer Maria Rilke. And now we welcome the new year, full of things that have never been. Now let's dive in. Here's a quick summary of what's been going on in markets. First up from Reuters, Tesla's annual deliveries fall for the first time as the company fails to strike a chord with consumers. What's our take on this news? Could this be a changing of the tides in EV dominance? Tesla's 2024 deliveries slid 1.1% from last year, despite Musk earlier predicting slight growth in 2024. The drop reflects the high interest rate environment, Tesla's aging models, and stiff competition, particularly from China's BYD. Despite offering interest-free financing and free fast charging, Tesla couldn't spark enough EV demand amid reduced subsidies in Europe and higher demand for cheaper hybrids in the US. Elon Musk is pivoting to self-driving taxis and has backed President-elect Trump, hoping easier regulations will help push autonomous tech forward. Possible cuts to the federal EV tax credit, plus doubts around Cybertruck's demand, add to the pressure mounting on Tesla's outlook for 2025. Next up from the Financial Times. Economists in recent polls say that Trump's MAGAnomics will damage growth. Could the bad outweigh the good when it comes to MAGAnomics? Leading surveys show most economists see Trump's America First stance as undermining global trade, boosting inflation, and weakening the economy over time. Ultimately, they view Trump's change as a way for the US to score some quick wins at the expense of a slowdown in the global economy, which would undoubtedly come back to haunt the US later on. Despite the bullish reaction in the markets, many analysts believe Trump's plans to raise tariffs, deport workers, and solidify 2017 tax cuts will hinder long-term growth. The impacts could be quite pronounced in Europe, as economists are worried that higher tariffs on China could flood European markets with cheap goods, hitting Germany's manufacturing sector hardest. The US is still expected to outgrow Europe in 2025, but economists warn that the uncertain policy environment could hold back both business investment and consumer spending. Next up from the Washington Post. Apple agrees to $95 million settlement in Siri privacy class action case. What's our take on this news? Maybe I wasn't crazy for thinking our phones are listening to us. Apple is paying out $95 million to settle a privacy lawsuit claiming Siri accidentally recorded users' private conversations and then sent them to third parties. While Apple did agree to the settlement, they still continue to deny any and all alleged wrongdoing. Despite the denied wrongdoing, Apple has agreed to delete recordings collected before October 2019 and be more transparent about its improved Siri program. If you owned a Siri-enabled device since 2014, you could file a claim, even if Siri's mishap was a one-time slip. Each claimant can submit accidental activation claims for up to 5 devices, with a maximum $20 payout per device. Next up from CNBC, Warren Buffett's Berkshire Hathaway once again beats the S&P 500. What's our take on this news? That's just the Oracle doing what he does best. Berkshire Hathaway soared 25.5% in 2024, surpassing the S&P 500's 23.3% and recording its best year of returns since 2021. Buffett sold a hefty $133 billion in stocks, including Apple and Bank of America, nearly doubling Berkshire's cash war chest to $325 billion. Geico helped drive Berkshire's operating earnings, rebounding from past telematics woes and more than doubling its underwriting profit. While Buffett acknowledges Berkshire's size may hinder big future outperformance, he expects slightly better returns than the average US company. And lastly, from the Financial Times, Global corporate borrowing reached $8 trillion in 2024. What's our take on this news? This can't come back to bite them, right? Global corporate bond and loan issuance jumped more than a third from 2023, with firms pulling forward 2025 borrowing in the wake of strong investor demand. Despite historically tight spreads, overall yields remain higher because of elevated treasury rates, attracting record inflows of nearly $170 billion into corporate bond funds. Pharma giants, tech companies, and retailers took advantage of cheaper borrowing costs, while some bankers expect further merger and acquisition-fueled debt issuance in 2025. However, analysts warn that spreads are priced to perfection and any meaningful widening could slow down the current borrowing frenzy. Now let's dive into the main piece: the macro picture for 2025. Most economists and strategists are in agreement that global growth will stabilize at around 2.8 to 3.2% in 2025 and 2026. Economies that experienced a recession in 2024 are expected to experience modest growth, while some of the strongest economies of 2024 are expected to experience a slight slowdown. Inflation is expected to remain under control, with the possible exception of the US, and most economies should see interest rates easing. While the economic backdrop appears stable, policy uncertainty, like tariffs, is a concern for many countries. JP Morgan Asset Management described it well, saying, "Out of the cyclical storm and into the policy fog." Other key themes for the year are the potential impact of China's stimulus program and what the next phase of the AI boom will look like. So, let's talk about potential positive catalysts for the year. Analysts are cautiously optimistic about equity markets, but there are a few catalysts that could lead to upside surprises. Firstly, innovation and productivity. The Gen AI investment cycle has been a reminder that innovation leads investment and growth. The models being developed by OpenAI, Google, and others led to investments in computers, with NVIDIA being the primary beneficiary. ChatGPT became a phenomenon in late 2022, and NVIDIA's revenue began to accelerate within months. If AI applications begin to prove themselves, another round of investment is likely to begin. Deutsche Bank pointed out that productivity gains slowed in recent years after rising for several decades. AI and automation has the potential to lead a re-acceleration in productivity that will be priced into the market as soon as it looks likely. Secondly, there's monetary easing. Most central banks are now in a rate-cutting cycle. Lower rates will be a key catalyst for most economies, with the possible exception of the US. If growth weakens, rate cuts should come faster. And thirdly, a Fed put and a Trump put. Tom Lee from Fundstrat pointed out that higher rates could be very positive for markets. Why is that? Well, higher rates would suggest the economy is in good shape and would also give the Fed lots of room to cut if things go wrong. Lee also reckons the Trump administration will measure its success by looking at the stock market. Assuming that's true, Trump might hit the pause button if the market reacts badly to his policies. These two puts imply there's a safety net protecting markets from a major correction, which is a positive for investor confidence. Now let's talk about some negative catalysts. On the negative side, there are numerous grey swans which could lead to economic or market weakness. Few analysts see these as very likely to be an issue in the next 12 months, but the probability isn't zero either. The most likely risk is an escalating trade war. It's not just the impact of Donald Trump's planned tariffs, but the response from other countries that could affect trade and inflation. Apart from tariffs, the geopolitical risks we listed in March haven't gone away. These include the wars in Ukraine and the Middle East and potential cyber attacks. Other economic risks include government debt, a possible resurgence of inflation, and China's economy. Now let's talk about the countries and regions and analyst expectations for them. The themes mentioned above are relevant to most countries, but there are also some dynamics specific to individual markets and to regions. Let's talk about the US first. Charles Schwab's outlook for 2025 has some great insights on US equities. It's also a lot shorter and easier to read than some of the other outlooks. Their first point is that there's a 2018 playbook for the impact of tariffs on inflation. This chart shows that companies not affected by tariffs may have a relative advantage. Secondly, cyclical stocks have outperformed consumer staples over the last 2 years. Cyclicals are usually correlated with manufacturing, but manufacturing activity is still flat over the same period. So, either manufacturing needs to pick up or cyclical stocks could revert to the mean. Thirdly, small cap stocks are also beginning to outperform. There are some catalysts that are very good for smaller companies, but investors need to be selective. Small cap companies have more exposure to floating rate debt, and far fewer small companies are actually even profitable. In other words, most small caps are very sensitive to interest rates. And fourth, there are quite a few reasons to expect more volatility in 2025, including policy uncertainty, the unknown direction of the AI trade, and sector rotation. So don't expect a smooth ride and be ready to take advantage of it. Citi's outlook for the year, and several others, mention that Trump's expected deregulation drive would enable banks to do business more easily and take on more risk. Deregulation could also favor small companies that spend more on compliance on a relative basis. Fisher Funds pointed out that the bar for meeting expectations is high, particularly in sectors like technology, raising questions about the sustainability of recent gains. Finally, from Russell Investments, this graphic illustrates the likely effect of US policy changes on various asset classes. Now let's talk about Canada. Canada is starting the year with some uncertainty over tariffs on exports to the US. The Royal Bank of Canada doesn't believe Canada will be the main target of US tariffs, as they would negatively affect the entire manufacturing ecosystem across North America. Beyond that uncertainty, Canada's economy should benefit from lower inflation and interest rates and recently announced tax relief measures. These factors are all positive for consumer spending. BMO favor technology stocks and cyclical sectors like consumer discretionary, financials, and REITs. Energy exports should also benefit from higher production and a weaker currency. However, this also depends on global energy prices. Likewise, other commodity producers stand to benefit from currency weakness, but that will also depend on global demand. Next, let's talk about Europe. Here, there's quite a lot of consensus on the outlook for Europe, perhaps too much. Economists expect a slight increase in GDP growth from 0.8% in 2024 to 1.2% in 2025. Most agree that Germany will continue to be a drag on the average. While economic growth is forecast to be underwhelming, many analysts are optimistic about European equities. Their reasons include 1. Falling rates and stable inflation and energy prices. 2. Low valuations relative to US stocks. 3. The weaker euro, favoring exports. And 4. Higher cash flows leading to stock buybacks. However, Goldman Sachs are more pessimistic on the economic outlook, but still see upside for stocks. They point out that retailers and travel companies should benefit from lower rates, but have less exposure to potential tariffs in the US. The Goldman Sachs outlook is a nice and fairly brief summary of the situation in Europe. Next, let's talk about the UK. The UK's government and central bank is having a very tough job balancing budgets, economic growth, inflation, and interest rates. The new government's budget is viewed as inflationary, which means UK interest rates could fall at a slower pace than in Europe. At the same time, several strategists are very optimistic about UK equities. They point to low valuations, very attractive dividend yields, and potential buybacks. This screener here, listed in the article, shows UK companies that score well on valuation, dividend yield, and health. Quite a few analysts have pointed out that low valuations could make companies in the UK and Europe targets for merger and acquisition activity, or outright buyouts by private equity groups. If that happens, it would probably generate even more interest in the region's equity markets. If you're after more detail on the UK equity market, Martin Curry published an excellent report on the opportunity for investors, and we have a link to that in the article. While we're on the subject of the UK, the Mastercard Economics Institute published some interesting charts on the divergence between consumer spending on experiences versus things. This doesn't only apply to the UK, it's happening in a lot of countries. The divergence was understandable when the pandemic ended, but it continued until earlier this year. Interestingly, the companies that benefit from this divergence might also be less exposed to tariffs. Next up, let's talk about China. China is dealing with the prospect of 60% tariffs at the same time as its growth is subdued and its property market remains in a slump. The government is now throwing a growing mountain of fiscal stimulus at the problem. Support for consumption is expected to be between 500 billion and 1 trillion yuan in 2025. HSBC's 2025 Outlook includes a chapter on the implications of stimulus measures for various sectors. The takeaways include 1. Real estate and local government debt is still in a precarious position. Various stimulus measures are taking time to improve the situation, and if a property sector recovery is to eventuate, it will take at least 2 years. Secondly, 30% of bank loans are tied to real estate, so banks are still vulnerable. Thirdly, e-commerce platforms and online retailers are benefiting from a government subsidy program. And fourth, mobile phones and PC sales are still in a slump. Some of China's sector PE ratios are very high. However, those ratios are for earnings over the last year, after a 3-year slump. If the tech sector's earnings were closer to their peak, the ratio would be around 50 times earnings and below the long-term average. How this all plays out depends on whether the stimulus programs trigger a sustainable growth cycle or not. Next, let's talk about India. India's economy outpaced every major economy in 2024, growing at about 6.8%, which was nearly 2% ahead of China. Economists expect the outperformance to continue in 2025, possibly widening even further. International investors are still optimistic about India, but chose to rotate into Chinese stocks when its stimulus program was announced. India's fundamentals are still strong, but other markets are viewed as better value. OCBC thinks India's stock market could see more robust domestic flows, particularly from the SIPs, systematic investment plans. This has actually been happening all along, but monthly inflows from local investors are now becoming significant. India is benefiting from the virtuous cycle that occurs as more of the population join the formal economy and middle class. You may have heard this before, but discretionary income increases, which results in more consumer spending, and in this case, more local participation in the stock market. Lots of sectors benefit from increased consumer spending, including banks. Barclays pointed out that private banks really stand to benefit as the number of affluent consumers increases. India also stands to benefit from an escalating trade war between the US and China and a possible trade deal with more attractive terms. Next, let's talk about Japan. Japan was another favored market at the beginning of 2024, and equities performed well during the first half of the year. Since then, the Bank of Japan's policy shift has changed the dynamics. Monetary policy is normalizing, which means higher interest rates and inflation, at least by Japan's standards. OCBC's 2025 Outlook highlights a few sectors that stand out. Firstly, with interest rates rising, the yen is one of the few currencies likely to strengthen in 2025. This favors companies with a domestic focus and those that import consumer goods. Secondly, higher inflation also means higher wages and consumer spending. Once again, this is a positive for consumer-facing businesses and banks. And thirdly, Japan's industrial companies are also positioned to benefit from increasing automation, both locally and overseas. For more detail and insight on Asian markets, have a look at the reports from OCBC and DBS, who are both based in Singapore. And lastly, let's talk about our hometown, Australia. Australia's economy is in a similar position to others that are hoping for lower rates. As rates come down, consumer spending should increase while the cost of capital decreases. That, along with attractive valuations in some sectors, should be positive for banks and consumer-facing businesses. With regards to exports, Australia has relatively limited exposure to potential US tariffs. On the other hand, Australia has more exposure to demand from China than any other G20 nation. So, the success or failure of China's stimulus programs will be pivotal for Australia's resource producers. They are exposed both to commodity prices and volumes. Schroeder's outlook for the market included this chart showing the relative weight of resource and financial companies in the index. The key point is that signs of rising demand from China could result in substantial rotation from financials to commodity producers. So, what's the insight here? Economic growth isn't essential for stocks. Most of the economies expected to see an uptick in growth in 2025 are coming off a very low base and are now aiming for quite modest growth rates. On the other hand, US growth is seen slowing after a very strong 2024. Economic growth is positive for the stock market as a whole, and particularly for cyclical stocks, but it really isn't essential for companies that benefit from long-term secular trends. Companies with growing markets or innovative, disruptive products can grow earnings in all but the worst economic environments. It's also important to differentiate between earnings growth that comes from long-term secular tailwinds, which can continue for decades, or from cyclical factors that may be short-lived. So, to take advantage of this, reading through some of the narratives written by the Simply Wall Street community is a great way to discover some companies that are likely beneficiaries of these long-term tailwinds. And that just about wraps up this week's Market Insights. To see the key events during the next week, have a look at the article and we'll provide a link to that in the show notes. So, that's all for this week's Market Insights. Thank you so much for listening. And until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data.